Have you ever wondered how stock market indices are calculated? These numbers you hear on the news every day are crucial barometers of economic health. A stock market index is a measurement of a portion of the stock market, calculated from the prices of selected stocks. It's a tool used by investors and financial managers to describe the market and to compare the return on specific investments. In this video, we will explore the most common method for calculating stock market indices, the capitalization weighted index. So, what exactly is a capitalization weighted index? It's one of the most prevalent methods of calculating stock market indices. This approach assigns a weight to each stock in the index based on its market capitalization, which is the total market value of all the company's outstanding shares. Let's delve a bit deeper. The formula for calculating a capitalization weighted index is as follows. First, you calculate the market capitalization of each stock in the index. This is done by multiplying the stock's current price by the number of shares outstanding. Next, you sum the market capitalizations of all the stocks in the index. Finally, divide this sum by a constant called the divisor to get the index value. This divisor is a vital element of the equation. It's used to normalize the index value, ensuring it remains comparable over time, even when there are changes in the number of shares outstanding or stock prices. When a stock is added to or removed from the index, or when there's a stock split, for example, the divisor is adjusted accordingly. The most well-known capitalization weighted index in the United States is the S&P 500, which includes 500 of the largest publicly traded companies. Other countries and regions have their own benchmark indices, each with its own methodology. Now that we understand what a capitalization weighted index is, let's break down the formula step by step. The formula for calculating a capitalization weighted index may seem complicated, but it's actually quite straightforward once you break it down. The first component of this formula is the stock price. This is the current market price per share of the particular stock we're analyzing. This value can fluctuate throughout the day as shares are bought and sold on the open market. Next, we have the number of shares outstanding. This is simply the total number of shares that are currently available for trading. It's important to remember that not all shares are always available for trading, as some may be held by insiders or major stakeholders who have no immediate intention of selling. These two figures, the stock price and the number of shares outstanding, are multiplied together to give us the market capitalization of the stock. The market capitalization represents the total market value of a company's outstanding shares and gives us a measure of the company's size. We then sum up the market capitalizations of all the stocks in the index. This aggregated value gives us an overall picture of the total value represented by the index. However, to make this figure more manageable and meaningful, there's one more step to the process. That's where the divisor comes in. This is a constant used to normalize the index value, ensuring that it remains comparable over time. This is crucial because changes such as stock splits or stocks being added or removed from the index can artificially inflate or deflate the total market capitalization. The divisor is adjusted accordingly to keep the index value consistent and meaningful. Once we have the sum of all market capitalizations, we divide this figure by the divisor to get the index value. This value is what you see quoted in the financial news as the value of the index. So in essence, the index value is the sum of the market capitalizations of all the stocks in the index, normalized by a constant, the divisor. Let's summarize what we've learned today. We've dived into the world of stock market indices, focusing particularly on the capitalization weighted index. This methodology assigns a weight to each stock in the index based on its market capitalization, which is the aggregate market value of a company's outstanding shares. The index value is calculated by summing up the market capitalizations of all stocks in the index and dividing by a constant, known as the divisor, to normalize the index value. We also touched on other types of indices, such as price-weighted indices like the Dow Jones Industrial Average, that add up the prices of individual stocks, and equal-weighted indices, which give each stock the same weight, irrespective of its market capitalization. Each of these indices serves different purposes and can provide diverse perspectives on the performance of a market or sector. Understanding how stock market indices are calculated is crucial for anyone involved in the financial markets, whether you're a finance student, an investor, or just someone interested in the world of finance. Thanks for watching.